Welcome back to Corporate Radar. The stock on the radar at the moment is Union Bank. Union Bank reported subdued loan growth but steady margins. The rise in return on assets and return on equity was encouraging, but slippages were worryingly high. Joining me now to decode the results is Mr. Nitesh Ranjan, the Executive Director of Union Bank. Mr. Ranjan, good morning and thank you very much indeed for joining us. Well, let me start with the worrying part first. The slippages rising from about 1% to about 2.4%. What accounted for the rise?
Yeah, good morning and thank you for having me here. If you recall, in the first quarter con call, we had said that we have a couple of accounts where we are likely to see the stress in the second quarter or the third quarter. Out of that, one account has actually materialized and it has turned NPA during the current quarter. That is why the delinquency ratio which you are seeing is higher. If you remove that one-off account, then delinquency is actually well below 1%.
Okay, I am assuming it is MTNL, but anyway, I guess you cannot mention names. But can we say this is a one-off? Will your slippage ratio start falling from Q3 and Q4?
Yeah, so let me give the perspective. Last quarter, we had said that we are seeing stress in two accounts, out of which one has now materialized. One still is on the radar. Okay, now if we look at the annual guidance for the slippages for the bank, we have told 11,500 crores for the full year.
Yeah.
As of now, 7,500 crores is the slippage in the first half. Now, if you remove this one-off in Q2, actually the slippage in the bank is around 1,800 crore only. So if I take that run rate, then we are still hopeful that we'll be able to maintain the guided level of 11,500 crores of slippages for the year.
Will you far undershoot it? That would be the hope, will you?
That would be difficult if the other account which I spoke about, that also realizes and turns into NPA.
Okay. What about the recoveries? You all have done 7,300 crores so far, compared to a guidance of 16,000. Will you meet that target?
Yeah, recovery for the last 2 years, we have been surpassing our own guidance. And this year also, we are very hopeful to do that. In the half year already, 7,300 crore of recovery is there. And there is a good pool of accounts which we are targeting through various methods. And I'm sure that we'll be able to cross that 16,000 crore of guidance.
Okay. The other encouraging part is the fall in NPA ratios. You have guided for 4% at the end of the year. Will you get there? You are now at 4.36, right?
Yes, we are in that direction. And that is something very, very sure that we'll be able to meet the guidance of 4% gross NPA.
Okay, that's good to hear. But the overall credit cost has risen. Will it stay at 1.1 levels or can it get even more troubling?
So actually, if you look at our guidance we gave in the beginning of the year also, this year's credit cost should be below 1%.
Okay.
And this increase in the credit cost for the quarter is because of the one-off account which has slipped. Barring that, actually, the credit cost on normalized basis is below 1%, which you should be able to maintain.
Okay. Well, you know, when you in the place where you have given up the breakup of your difficult loans, there is a slippage in LC and others. Is that something we should worry about in the slippages?
No, so that one large account, LC is the large corporate division. Yes.
Okay, that is included under LC, is it?
Yes.
Okay. Did you have any trouble with unsecured loans and MFIs? What is the performance?
So our total unsecured loan portfolio is around 12,000 crore, which is around 1.5% of the total loan book and around 7% of the total retail loan book. If you look at the growth, it is almost flat YOY in the unsecured loan. And the delinquency ratio is quite manageable at around 1.45%. Entire unsecured loan gross NPL also, if you look at today, it's below 2% level. So far as MFI is concerned, our exposure is very limited. Hardly, I think, 20% of the loan book is to the MFI and few marquee names only, not many players. And we don't see any stress in our loan book to MFI as of now.
Okay. Let me come to growth. It is a bit troubling that your advances are lower, quarter on quarter, 1.6% lower. How do you see the second half growth in loans?
Yeah, I think the quarterly and YTD growth, we should split into RAM and the non-RAM sectors. RAM sector still QOQ also, there is a 5% growth rate aided by the retail, agriculture and MSME. There is a flat growth in the corporate and as we have been telling that our focus in the bottom line, we don't want to grow just for the top line and sacrifice the bottom line. So there is some kind of sacrifice in the large corporate book we have done where the pricing was very, very kind of challenging for us, and we have sacrificed that. Otherwise, it's okay. 11 to 13% is the guidance for the annual growth rate in advances. And I think the RAM sector should support that. In the festive season, we are seeing very good demand in retail. MSME, since middle of the August, we are seeing good pickup in the sanction and disbursement. And we should be able to reach to our guidance level for advances.
Okay. What would your guidance be for loan growth?
That is 11 to 13%. Okay. We should be anywhere in between the guidance range.
Okay. Okay, that's good to hear. I think your LCR ratio is very healthy, 144%, if I'm not mistaken. Would you maintain it at this level? Would you run it down? And what impact can it have on margins if you brought down your LCR?
I think LCR is a comfortable level. We should also factor in the RBI's draft guideline on the increased runoff factor that will take anywhere between 10 to 12% from the current level of LCR that we are reporting. So which will be around 125 to 130% if I factor in that runoff thing.
Mr. Ranjan, just a few more questions. If the, you expect the LCR rules perhaps to come in the second half. Do you also expect the higher provisioning on project finance to come? And if that comes in the second half, what may be the impact?
See, I think I have on your channel told earlier also in the guidelines, draft guidelines came that this is a very prudent and forward-looking approach that RBI has proposed. I'm not sure when those guidelines are going to be finalized and in what shape, because different stakeholders, including banks, have given our suggestions. So depending on that, we'll take. But I think if I remember the number, the impact is not very significant.